The Federal Reserve's recent meeting sent ripples through the stock market, with the NASDAQ in particular experiencing a surge of optimism. This enthusiastic response underscores the market's sensitivity to the Fed's monetary policy pronouncements. Like a conductor leading an orchestra, the Fed's actions have the power to influence the tempo and direction of the financial markets. The question on everyone's mind is the music about to change. The initial market reaction was nothing short of exuberant. Major indices, led by the tech-heavy NASDAQ, rallied as investors digested the Fed's statements. The S&P 500, a broader measure of the market, wasn't far behind, posting significant gains. These positive movements reflect the market's anticipation of a potential shift in the Fed's stance on interest rates. However, the initial euphoria was tempered by a more cautious undercurrent. The Fed, while hinting at potential rate cuts in the future, also painted a somewhat cautious picture of the economy. This mixed messaging has left investors both excited by the prospect of looser monetary policy and wary of potential economic headwinds. The market's response to the Fed's meeting highlights the intricate dance between monetary policy and investor sentiment. Deciphering the Fed's signals and understanding their implications is crucial for navigating the ever-evolving landscape of the financial markets. As the market absorbs the Fed's words and awaits further economic data, the question remains, will the music continue to play, or are we approaching a discordant note? The Fed's recent meeting has left market participants parsing every word and nuance, attempting to discern the central bank's true intentions. While the decision to hold interest rates steady was widely anticipated, it was Chair Powell's remarks that stole the show. His hints at potential rate cuts in 2025, coupled with the revival of the term transitory in relation to inflation, have fueled speculation of a more dovish stance. The potential for rate cuts, even if 2 years out, has been a significant driver of market optimism. Investors, particularly those in growth-oriented sectors like technology, tend to favor lower interest rates, which reduce borrowing costs and boost corporate profits. The NASDAQ's strong performance following Powell's comments reflects this sentiment. Adding to the intrigue was Powell's use of the word transitory, a term that had fallen out of favor in recent months as inflation proved more persistent than initially anticipated. By resurrecting this term, albeit in the context of tariff-related price increases, Powell has reignited the debate about the nature of inflation and the Fed's likely response. The market's focus on potential easing, despite the Fed's downward revision of growth projections and upward revision of inflation forecasts, speaks volumes about the power of forward guidance. Investors are clearly betting on the Fed's willingness to pivot towards a more accommodative stance, should economic conditions warrant it. However, the central bank's commitment to its dual mandate of price stability and maximum employment remains unwavering, leaving the market guessing about the timing and extent of any future policy adjustments.